Okay, this is Chapter 9, Part 3 of our lecture videos. And just to go ahead and finish up our straight line method example. So in 2020, our last year, once again, we'd have a similar entry: debit depreciation expense, credit accumulated depreciation, again for $4,500. That would bring our balance in accumulated depreciation up to $18,000. And $20,000 minus 18 would bring our net book value down to $2,000. Now, if you noticed, the total amount, and that's our 4-year life. If you noticed, the total amount in our accumulated depreciation is $18,000, which is equal to, up above, our depreciable cost. So that is the total amount that we're going to depreciate. We're not going to depreciate any more than that. And you'll notice that the $2,000 net book value equals our residual value. We're never going to depreciate below the residual value. So these numbers are going to be the same no matter what method we use. So we don't even need to change those numbers at all, no matter what method we're going to use. Okay, so that's the straight line method. Again, simply proportional to time. So in this case, we have 4 years useful life of the asset, which means that each year we're going to just depreciate 1/4. We're going to take our total asset value, cost rather, and subtract a residual value. That's going to give us our depreciable cost, the total amount we're going to depreciate, in this case $18,000. And 1/4 of that is $4,500, and we're going to do that each year. All right, so let's, I'm going to go ahead and erase this, and we'll take a look at units of output. All right, so under the units of output method, and I'm just going to write that here. This is the units. And again, I just erased the items from in the table. You'll probably want to construct another table for this particular method. So this is the second method. And again, here, what we're going to use is, instead of 4 years, we're going to use the useful life of the machine being 45,000 hours. And again, it's broke out according to this table over here on the right. 12,000 hours in the first year, 12,000 in the second, 11 in the third, and 10 in the fourth. So that's how we're going to go ahead and calculate that. So what we want to do is we want to go ahead and compute the amount per hour, the amount of depreciation per hour. So we're going to take our depreciable cost, which is the total amount we're going to depreciate, which is $18,000. And instead of dividing that by the useful life of 4 years, we're going to divide that by the useful life of 45,000 hours. And what we're going to get is we're going to get $0.40 for each hour. So that's the depreciation rate. So every hour we use the machine, we're going to depreciate 40 cents. So in 2017, we're going to use the machine 12,000 hours. So our depreciation expense is going to be 12,000 times 40 cents. So that's going to give us a depreciation expense of $4,800. So again, our entry over here on the right would be debit depreciation expense, $4,800, and credit accumulated depreciation, $4,800. This would be the first year's depreciation expense entry. So balance in the accumulated depreciation account, $4,800. 20,000 minus 4,800, $15,200. Okay, in the year 2018, we're going to do the same thing. We use the equipment 12,000 hours. So again, same calculation, 12,000 times 40 cents is going to give us 4,800 again. I'm not going to do the equation to keep from getting too messy. And so our total accumulated depreciation balance now would be 9,600. And our net book value would be 10,400. 2019, we're using the machine 11,000 hours. 11,000 hours times 40 cents is $4,400. That would increase our accumulated depreciation to 14,000. 20,000 minus 14,000, $6,000 net book value. And the fourth year, we're using the equipment 10,000 hours times 40 cents, $4,000. That would increase our accumulated depreciation to 18,000, and again, our net book value would be 2. So we still end up at exactly the same place. It's just that each year our numbers are going to be a little different because our units of output are a little bit different than they would be under simply the straight line method. Again, trying to match the use of the machine with the revenue that it's producing, and probably a better matching than simply the straight line method. So that's our units of output method. So I'm going to go ahead and erase this, and we'll look at the double declining balance method. Okay, so the next method is our double declining balance. And if you remember, double declining balance method was we're going to use a rate of 2 times our straight line rate. Now our straight line rate here is, since we have a 4-year life, our straight line rate is 1/4, 1/4. It's a 4-year life, so each year we're depreciating 1/4 of the total depreciable cost. So we're going to use 2 times that. So 2 times 1/4 is 2/4, or 1/2. So 1/2 is the rate we're going to use for our double declining balance calculation. And what we're going to do is we're going to take 1/2 times whatever our net book value is at the end of the preceding year. So here, or at the beginning of the year. So here what we're going to do is we're going to take, for the end of 2017, we're going to take 20,000 times 1/2. And that's going to give us $10,000. So our first year, we're going to depreciate a total of half of the asset. So you can see how accelerated that is. On a straight line basis, if you remember, we only depreciated $4,500. Here we're depreciating $10,000. We're getting an extra $5,500 tax deduction because we're using this method. And so that's a significantly higher tax deduction than we would by using the straight line rate. So here, using the double declining balance provides a significant tax benefit. So again here, our entry for that first year would be debit depreciation expense 10,000, credit accumulated depreciation 10,000. So our accumulated depreciation account would be 10,000. 10,000 minus 20,000 minus 10,000. So our net book value is 10,000 at the end of the first year. So it's half of what it was at the beginning of the year. All right, then for 2018, what we do is we take the same rate times, again, the declining balance. The declining balance is the net book value. So we're taking the 10,000 from the previous year times our rate of 1/2. So here we're going to be depreciating 5,000. So again, we're taking this 10,000 here times 1/2, and we're getting 5,000. So our entry would be debit depreciation expense 5,000, credit accumulated depreciation 5,000. So here we'd have 15,000 of accumulated depreciation, 15 from 20, so we'd have a net book value of 5,000. Now we're going to take this 5,000 net book value and then multiply that by 1/2. And here we get a $2,500 depreciation expense in year 3. Add that to our 15, we're going to have a balance of 17,500 in accumulated depreciation and a net book value of 2,500. Now here we can't just take the 2,500 times 1/2, or we'd get too much depreciation and we would fall over the 18,000 and we'd fall below the 2,000. So remember, we cannot go below the $2,000 of residual value, and we can't depreciate anything more than 18,000. So all we have to really do is determine how much more depreciation do we need. And we really we can see we really only need another $500. So this $500 we're just going to calculate as just the difference that we need to get from our $2,500 net book value to our final 2,000. And so we're just going to go ahead and calculate that from our net book value numbers. So we're not going to use our rate to determine that. So those would be the figures for the double declining balance. So let's just, I'll come back in a second. So let's take a look at what would happen if we were to sell the asset. And we're going to make this simple because we're going to assume right here that we're selling the asset right at the end, right after we make this entry in 2018. So on 12/31 of 2018, we make our depreciation entry, and then we're going to assume that on 1/1 of 2019, we sell the asset for $4,000 of cash. Okay, so we're going to go ahead and record the entry to give effect to that transaction. Okay, so first of all, we know we received cash, so we can debit cash for $4,000. And you can stop the recording too and see if you can figure out how to make this entry. The other thing we need to do is, obviously there's some accounts that are going to now go away. That asset is now gone, and we're going to have to give effect to the fact that those accounts are no longer here. First of all, the asset account is no longer here. So when we purchased the asset, we debited the account for $20,000. Now we need to credit the asset account for $20,000. So that would remove the asset account, and that account would now be 0. The other account that we have to think, so that would be gone. The other account that we have is the accumulated depreciation account. That, as you know, is a contra account, so it's a credit, and it has a balance of $15,000. So we would want to debit accumulated depreciation for $15,000, and that would make that account go away. It would go to 0, and that would be gone. Now what we have is we have $20,000 of credits, $19,000 of debits. We need another debit. A debit then would be a loss. Debits are always expenses, for instance. So loss on the sale of the asset. And if we calculate that, we calculate it to be $1,000. So you'd have a $1,000 loss on this sale. And that's how you would record the disposal of the asset.